Good afternoon and welcome to today's Learn at Lunch webinar. This is part of an ongoing series that we've been doing. Previous webinars and other farm management resources may be found on the farm management website, and I will paste the address into the chat box in the lower right-hand corner. If you have questions during the webinar, feel free to ask them using the same chat box. Today's speaker is Dr. Rodney Jones, a faculty member here in the Agricultural Economics Department at Oklahoma State University. Dr. Jones, I'll turn it over to you now.
Well, thank you, Brent. If you're not hearing me clearly, somebody comment in the chat box. Otherwise, I'm just going to forge ahead here. Welcome to our Learn at Lunch webinar series. Again, as Brent mentioned, I'm Rodney Jones, and in this webinar, I want to visit with you about a topic that unfortunately all businesses face at some point in their lives. And that's the topic of financial stress and the keys to successfully dealing with it. The reason we thought that might be a timely topic here today at the beginning of 2018, we do know that there are some of our agriculturally related businesses, particularly some producers who primarily focus on the area of crop production, that may be starting to experience a little bit of financial stress due to the extended period of low crop commodity prices. There may be other producers out there who are experiencing some financial stress for a variety of other reasons, and we don't have a really great handle on the degree or the amount of financial stress that we're seeing out there in the ag sector, but we are getting some indications that there are at least pockets or individual producers who are experiencing some degree of financial stress or financial difficulties. So we thought it was a timely topic to address now as we kind of enter that time of year when we start to evaluate our farm business performance for the last year and make some plans for the upcoming year. Specific topics that I want to cover today include how to diagnose a farm business problem, because after all, before we can address a problem, we need to identify exactly what it is, how to make the important distinction between short-term financial stress and longer-term financial stress, and finally, a very closely related topic that often gets confused with other aspects of financial stress. That's the topic of how large the business needs to be to accomplish the goals and objectives that we have in mind for a particular farm business operation. One of the most critical aspects of diagnosing a farm business problem is to identify specifically which subset out of the 5 primary categories of farm financial position and performance that specific business being examined is contributing to the problem. Which of the 5 categories of financial performance are contributing to the problem at hand? For example, we could have a farm that's very solvent, perhaps even profitable, but is experiencing debt repayment and liquidity problems that are causing financial stress. We could also see the opposite. Farms that seem to have plenty of cash but have a persistent long-term profitability and perhaps even solvency problem. Finding at least one, or even better, multiple measures that are consistently monitored to reveal position and performance in each of the 5 categories of liquidity, solvency, profitability, financial efficiency, and debt repayment ability is an absolutely essential management practice for everyone. That practice becomes even more important when trying to evaluate and manage through a financially challenging situation. Recall that the most commonly used liquidity measure is the current ratio. For illustrative purposes, I've calculated the end-of-year farm current ratio for an example farm. This family did have some non-farm activities reflected on the overall balance sheet, so I used the ending value of current farm assets divided by the ending value of current farm liabilities. These numbers, of course, come straight off the balance sheet, and as you can see, the resulting value in this simple little example is 1.38, meaning that the farm has $1.38 worth of current assets for every dollar in liabilities that need to be paid over the following year. To put that number into perspective, I've included a graphic of the little spotlight scale for the current ratio that comes from the Farm and Ranch stress testing publication from OSU. I'll have a reference to that later on. This shows the industry consensus benchmark for this measure on a scale of from low stress to high stress. For most typical farming operations, anything above about a 2 would be considered a fairly low stress situation. For this particular measure, a higher number is of course better. Anything under 1 would certainly indicate that liquidity may be an issue for a particular farm. The 1.38 measure for this particular example farm is in the OK category, but is certainly an indicator that the manager would want to carefully monitor that farm's liquidity position, because any deterioration in this measure would signal a potentially upcoming problem. One of the most common solvency measures, and the one that I see most often utilized, is of course the debt to asset ratio, which is just what it sounds like: total farm liabilities divided by total farm assets. In our OSU example balance sheet, we simply have to add the current and non-current categories for both liabilities and assets to get the totals, as I've kind of illustrated here. Again, I've used the end-of-year values for this illustration. Recall that some analysts like to use the average of the beginning and ending year values. The important point is to be consistent in how you calculate these measures over time. In this example, the result is a debt-to-asset ratio of about 0.328, or approximately 33%. The associated graphic from the industry standard spotlight scale, again from the Farm and Ranch stress test publication, shows where that 33% kind of falls on the scale. Here, anything under about 30% would be considered low stress. For this ratio, of course, a lower number is better from purely a financial position standpoint. Anything over about 60% or 0.6 indicates that a particular farm could be getting into a stressful solvency position. At 33%, this example case farm is in pretty good shape right now from a solvency perspective. Let's look at a profitability measure. Here we show the example profitability measure of return on farm assets, or ROA. That calculation is based again on our example farm numbers. Net farm income, of course, comes from the accrual income statement, in this case $14,345, and interest expense also comes directly from the accrual income statement. Recall that for the return on assets measure, we need to subtract off a charge for unpaid operator labor, something that represents the value of the labor contributions that are not explicitly paid for in a family business. In this case, we're going to use $10,000. We often go to the cash flow statement to get relevant numbers, looking at family living needs and those types of things to get that estimated unpaid family living number to put into the calculation here. Let's see. In the denominator, we need a total farm asset value. Since return on assets is a measure of financial performance over time, it makes sense to use an average of the beginning and ending values for farm assets in this case. The resulting value based on our example numbers here is 0.026, or about 2.6%. So let's look at where that falls on the scale of financial stress. So again, this 2.6% number can be compared to agricultural industry benchmarks using the example stoplight graphic. These benchmarks suggest that a return on assets above 5% in agriculture, the way we've calculated here, would generally be considered fairly low stress, and a return on assets below about 1% would be considered on the low or potentially high stress end of the scale. Our example farm here is sort of in the middle. It's okay, but we'd like to see a bit stronger number. As a side note here, that benchmark return on asset number of 5% might seem a little low to some listening here today compared to some alternative investments. But keep in mind that we generally do not include unrealized capital gains, especially on owned real estate, which makes up a large share of the average farm balance sheet, as an income item in the calculation. This is, of course, a form of income, albeit unrealized, that many farmers benefit from that does not show up in the typical return on assets calculation. So a 4 or 5% return on asset calculation on a typical farm might not actually be as far below the return to other alternatives as it might seem at first glance. At any rate, the way we calculate the number in agriculture, 5% would be considered a fairly strong number. Here again, for our farm, we're at 2.6 or kind of in the middle. As an example of a very common farm financial efficiency measure, here we're going to calculate the asset turnover ratio for our example farm. We use gross farm revenue, which comes off the accrual income statement, as illustrated here by the screen capture graphic, and divide by the total farm asset value, the sum of current and non-current assets. Here we're using the average of the asset values from the beginning and ending balance sheet numbers, since this is a measure of financial efficiency over the period represented by the accrual income statement. Here our calculated asset turnover ratio is about 0.156 or about 15.6%. When compared to the industry benchmark scale, this looks a bit on the low side. Industry standards suggest that a value above about 0.4 would be considered low stress for a typical ag business, and anything under about 0.2 might be a sign of a financially stressful situation. So let's examine our example number a bit closer. Like many farms and ranches, the total value of this farm's asset base is heavily weighted by real estate and buildings, which in many cases have a lot of non-ag influence or non-ag value built into the market dollar value that is recorded on the balance sheet. In situations like this, the denominator of our asset turnover ratio calculation is very large due to the non-ag influence on those balance sheet values. That in turn results in a relatively low asset turnover ratio when compared to the industry benchmarks. Is this a problem? Not necessarily in this instance. The critical thing to remember here would be to monitor that asset turnover ratio over time and calculate the impact of any proposed major purchase on the asset turnover ratio to see how it might change over time. Using that 15.63 as a benchmark to compare to, rather than focusing too much on the fact that it certainly is a bit low when compared to industry benchmarks. And perhaps it might be a good idea to calculate a few additional financial efficiency measures just to assure ourselves that there's not a serious financial issue developing. Finally, as an example of a repayment capacity measure based on our example farm values, here we work through the calculations of the term debt coverage ratio. The first step is to calculate all sources of income that could potentially be used to make principal and interest payments. And capital lease payments if relevant. So what we're looking for is a measure of our ability to make principal, interest, and capital lease payments. We start with the net income from the farm off the accrual income statement, add in non-farm wage and salary income. That usually comes off the cash flow statement. We then add true management depreciation expense back into that net income because it is a non-cash expense, so that cash would be available to make principal and interest payments. And we also add the interest expense payments back in from the accrual income statement. That money is currently being used to make interest payments, so it certainly would be a number that would be available to make principal and interest payments. We subtract off taxes and family living withdrawal expenses because those have to be paid before we can allocate any remainder to debt service payments. Both of those values are going to come to us off of the cash flow. The denominator in this ratio is the sum of principal and interest payments on term debt that need to be made the following year. These values typically come from the cash flow as well. So, for our example farm, the result of this calculation is about 1.13 or 113%. What does this tell us? It tells us that the farm family in this example basically has about a 13% projected cushion with regard to their ability to meet term debt payment obligations for the following year. The graphic of an industry benchmark scale suggests that anything above about 135% would be considered a low stress situation, and a number under about 110% would be a potentially financially stressful situation. For our example, at 113%, we're at the low end of the range that would still be considered in the yellow there or acceptable. So this is definitely a number that needs to be watched closely on this particular farm. Any revenues or cash inflows that fall short of expectations might result in a situation where the farm would have trouble making those debt payments for the following year. One issue that may be causing financial stress in any specific situation is the size or scale of the farming operation or individual enterprises within the overall farm. This issue has a couple of different dimensions that need to be looked at. First, what economists call economies of scale is a very real issue in many agricultural enterprises. In order to possibly be a low per unit cost producer, low cost per bushel, low cost per pound of calf produced, etc., it's sometimes necessary to spread those fixed costs, machinery and equipment being a big one, over some minimal number of acres or head, etc. This phenomenon is particularly pronounced in commodity crop production. It becomes very difficult to be a cost-competitive producer without at least a certain number of acres to spread those fixed costs over, and the market will likely not allow prices to ever remain consistently high enough to reward producers who are not cost competitive. It's hard to put an exact number on the size that is needed because every situation is, of course, different. However, for most commodity crops, most common crops grown in Oklahoma, like wheat, grain sorghum, etc., I think the evidence suggests pretty clearly that it's going to be very difficult to be a low-cost producer with less than at least a few hundred acres, and in some cases, likely much more than that. Economies of scale appear to be somewhat less dramatic, if you will, for an enterprise like a cow-calf production situation. That's likely because a small-scale cow-calf producer can conceivably get by with a fairly low investment in fixed assets like machinery. That doesn't mean they will in every case, but they potentially can. The second dimension of scale relates to simply being large enough to fully employ the amount of labor that is relying on the farm business for income, for example. Every farmer or rancher is busy. We know that. The real question is, are you producing anywhere near the value of production per person or per hour of labor utilized on the farm as other farmers or ranchers in your area who are the most productive as measured by those definitions. Over time, again, the overall market will migrate to rewarding the most productive producers in the industry, and those who are dramatically less productive with regard to the use of their labor resource will in the long term be disappointed with the magnitude of financial rewards that their farm or ranch is able to produce. So just expanding on that point a little bit, it's essential that a farm or ranch business fully employ the labor resources in proportion to the amount of money that those labor resources are in a sense drawing from the farm operation, either in terms of employee pay or family living withdrawals for family members working on the farm. One of the issues is that people come in one-person units. If you hire someone for a day, you must keep them productively busy for an entire day. If a family member devotes a certain number of hours to the farm or ranch operation, either part-time or full-time, then they need to be efficiently producing something of value during that entire time that they're working on the farm, or they need to reduce the expectations regarding how much income the farm can realistically provide for them. That means constantly thinking about how to keep the labor resources productively utilized. In times of financial challenges or financial stress, that may mean eliminating or reducing the amount of hired labor. It may mean that the farm family members need to seek a little bit of additional off-farm employment because there are times when the farm simply may not be able to generate the needed amount of family living. It may mean adding a more labor-intensive enterprise if the farm wants to keep more family members actively engaged in the farming operations. Livestock operations are quite often and have historically been a good way to do this. Along those same lines, it may mean expanding the current farming operation to more fully utilize that labor resource that is available and it is drawing financial resources off of the farm. Financial shortfalls can often be the result of substandard physical performance. Yields, daily gains, and other performance measures are not what they need to be. Comparisons of your farm's physical performance measures with benchmarks from comparable farms, even county averages, can be a good place to start. And that's one way of assessing your farm's physical performance. You may want to look at long-term averages, especially in a state like Oklahoma, where weather events in any one particular year can certainly result in disappointing yields or disappointing other performance measures. The important thing is to watch how am I doing compared with others, especially in the same geographic area. Physical performance obviously translates directly into economic performance, which can, of course, cause financial hardship or financial stress. Another important point to watch could be financial structure, which can be an important contributor to financial stress. For most of us, debt is a necessary aspect of managing a farm or ranch business, as it allows us to grow and develop our business at the necessary pace. However, we all know that too much debt, too high of a debt-to-asset ratio, for example, can really magnify financial challenges. In a low-return year, interest costs can quickly overwhelm what little margin is left, resulting in the farm having to dip into equity reserves just to pay the interest. Wealth can deteriorate quickly in a highly leveraged situation. Obviously, higher debt levels mean higher annual principal and interest payments, which can result in severe liquidity and debt repayment capacity challenges. Finally, high debt levels result in less collateral cushion to fall back on when times get a little tough or when the opportunity comes along for that significant purchase that might benefit the farm in the long run. A critical question to ask anytime we are trying to monitor a financially stressful situation is whether the financial stress being felt is short-term in nature, or is the problem more internal and longer-term in nature. Just to reiterate, it's critical that the exact source of the problem be identified so that the manager can get ahead of the problem quickly, manager and lender combined. Short-term financial stress is usually the result of forces largely beyond the control of the manager, or external forces. Things like drought, periods of exceptionally low prices like we're experiencing in our cropping enterprise right now, are usually considered to be short-term in nature. Interest rate hikes to levels that are historically high typically don't last very long. However, keep in mind that at the time of this webinar, we have been in an extended period of historically low interest rates, so some modest increases from these current levels may not be short-term, but rather may be returning to more normal long-term levels. Poor debt term structure can be the result of a one-time purchase event that just needs to be refinanced. For example, I often see the situation where a farmer uses his or her operating credit line to purchase a significant piece of machinery at an auction over a weekend, for example. That person just purchased a non-current asset using short-term financing. Really, they need to go in and visit with their lender about stretching that debt out over a few years to be more consistent with the expected life of the underlying asset. Sudden and dramatic drops in collateral values, like what happened with land and equipment in the 1980s, can certainly cause financial stress. Lenders can quickly become concerned about their collateral margin if, for example, they loaned 70% of the value of land based on values from a few years ago, and in the meantime, land values in their particular area have dropped significantly, say by 30 or 40%, then that lender and or their regulators may insist on a collateral margin being improved in some way, shape, or form, and that can certainly cause some short-term financial stress on the part of the borrower as well as the lender. So, agricultural producers basically have about 3 lines of defense when short-term financial stress begins to show up. They can respond by managing cash flow, managing liabilities, or managing assets, or some combination of the 3. More on each of these 3 strategies in the next few slides. However, I will note that the first signs of financial stress always show up as a cash shortfall. We simply don't have enough cash in our checking account to pay the bills as they are rapidly accumulating and rapidly coming due. We manage cash flow in several ways. Our first line of defense is, of course, to control costs. Carefully figure out which costs in various enterprises can be reduced or squeezed a little bit without harming production very much or at all. Oftentimes we become a bit lax during the good times, and we find that we can tighten the belt a little bit without really impacting productivity as times get a little more challenging. Producers all over the United States are having discussions with landlords about renegotiating cash rents due to tight crop production margins. There, of course, is no guarantee of success, but if the landlord discovers that other producers in the area have the same concerns that you do, and that the rental market is softening, there may be some room for at least short-term negotiation. Another common cash flow management technique is to simply delay large capital purchases. Repair for another year or so rather than replace. We see producers all over the United States employing that cash flow management strategy during these more difficult times. Cutting back on family living withdrawals from the business is another common cash flow response. That works in the short run. A lot of families can cut back on family living a little bit, but certainly there are limitations to how successful that strategy will be. Finally, figuring out ways to get some cash out of underutilized equipment or facilities, and increasing non-farm income sources are common responses to a cash flow management scenario. Ways to manage liabilities include negotiating extended loan terms or even negotiating the opportunity to make an interest-only payment for a year. A large lender in the state north of us recently sent a letter out to all of their, at least what they would consider to be good customers, offering them the opportunity for interest-only payments for the upcoming year on notes that had more than a year left to go. So that's becoming more and more common again, as it did in the last period of financial stress in agriculture. Recent surveys of agricultural lenders reveal that renegotiating existing loan terms has been a common practice over the last year or so as financial stress has increased. Liquidity positions can sometimes be improved by mortgaging long-term assets to borrow additional funds to pay short-term bills with. As sort of an opposite approach, sometimes debt can be reduced by selling unproductive assets or assets that aren't utilized as much as perhaps they need to be, or by utilizing off-farm income or capital sources to pay down debt. Also, sometimes there are opportunities to refinance existing debt at lower interest rates, either because rates have come down since the original loan was taken out, or by exploring other options such as Farm Service Agency guarantees and other programs that might be available. Managing assets to address short-term financial stress usually involves liquidating assets to pay bills. This may not be a bad strategy, especially if the farm or ranch family has some assets that are otherwise not being productively used. One thing to keep in mind if you are thinking about employing this strategy, or if some of your customers need to perhaps consider this strategy, well, really two things to keep in mind. During financially stressful times, sometimes the market value of those assets that could potentially be liquidated has gone down and is under some market pressure, so they may not be worth as much as we would like, or as would be the case during better financial times. The second thing to keep in mind is if you're selling a low tax basis asset, there may be some income recapture or capital gains tax consequences that would need to be considered. If the financial stress problem is persistent over several years, even during times when other agricultural producers in the area are doing well, that's an indication that the problem is not entirely external, but may be an internal fundamental profitability or financial efficiency issue. Those short-term strategies that we just talked about will not solve the problem in the long run. Reasons for the profitability or efficiency problem need to be identified and resolved. This can take time, and in the meantime, there may need to be some short-term financial stress management strategies employed, but the bottom line is those strategies will not solve the underlying problem if the problem truly is longer-term in nature. One thing I want to point out is that financial stress is often confused with profitability. To illustrate that point, it's quite common to see a farm business that is fundamentally profitable, but just not large enough to support the level of family living that is being drawn off of the farm. This issue often shows up at generational transition time, when a farm that has historically been supporting one family, for example, is suddenly asked to support more than one generation, at least for a while, as the younger generation returns to the farm to try to get started. For the purposes of this discussion, I'm going to assume that the farm and its various enterprises are of sufficient scale to address the issues mentioned earlier, that of being a reasonably low per unit cost producer. I'm also going to assume that there are not any access to markets issues, which for some enterprises can be the case. The farm simply needs to be of a certain size to get the attention of relevant buyers. However, for most of our commodity farm products, that's not really an issue. So I'm going to assume for the next few minutes discussion that's not the problem. What I want to focus on is the issue of farm size as it relates to that second point on the slide here, meeting the income needs or the operator's needs for income for family living and other purposes. That question can be addressed by answering 3 questions sequentially using some basic information from recent financial performance. The first question, what are the net income needs from the farm? This is primarily the family living needs, but it could also include a cushion for an annual growth target, for example. So based on that answer to that first question, the second question that needs to be answered is what level of gross income is needed to produce the amount of net income revealed in the answer to the first question. The third question then becomes how much investment, i.e. how big of a farm is needed to produce the level of gross income that is needed to answer the question asked in question number 2. So we sequentially ask this set of 3 questions. Let's work through a quick example here. So let's say, for example, that a part-time farm operator would like for the farm to generate $15,000 per year on average for family living and a little bit of equity growth. That's the answer to question number 1. That's just something that the family comes up with in discussions with them. We can use the recent historical net income from operations ratio. That's the net income divided by the gross income from that exact farm. Both of those numbers come off of the accrual income statement. So we use information from that exact farm from, say, the previous year or the average of the previous couple of years to then answer question number 2 in a very systematic mathematical fashion. We simply divide the net income needed number, the 15,000 in this example, by the net farm income from operations ratio that we calculated based on this farm's numbers, 0.12 in this example, and that reveals the answer to question number 2. In this case, we need for that farm to generate an average of around 120,000 in gross income in order to meet our net income withdrawal and growth number of 15,000. We then take the answer to that question, question number 2, and again, in a very systematic mathematical way, we divide that by our farm's recent asset turnover ratio. That's the gross income off the accrual income statement divided by the value of the farm asset base off of our balance sheet. That's the asset turnover ratio that we talked about earlier. We use that to arrive at the dollar value of the asset base, i.e. farm size, that's needed to accomplish our goal. Well, of course, that's interesting, but it's sort of self-fulfilling, right? We're using the farm's historical performance numbers to basically tell us what the farm is currently doing. The more useful application is when there's an impending change. In the example that I'm talking about here, perhaps there's an additional family member who wants to come back to the farm and would like for the farm to generate, say, $50,000 per year for them to live on as a full-time farm operator and manager. Let's see what the analysis tells us in this hypothetical example. So, now instead of 15,000 in net income needed, we need an additional 50,000 added onto that, or we need 65,000 to accomplish the goals that we have in mind for this farm in terms of net income. So that's our answer to question number 1. We now need 65,000. We use that information along with that farm's recent historical net farm income from operations ratio, the 0.12 talked about earlier, to discover that the farm would need to generate about $540,000 in gross income to make that happen. The answer to question number 2. Now instead of $120,000, now we're at $540 or so. We then use that information and the farm's recent historical asset turnover ratio to quickly discover that we need to expand that farm from a $750,000 farm, a $750,000 farm asset base, to about a $3.4 million asset base to accomplish the goals that we had in mind as we bring this new person back into the farming operation. Going through this simple analysis can help facilitate discussions among family members about how to get there over time. Obviously, that's not going to happen between now and May, for example, when the younger family member graduates from Oklahoma State University. So how do we get from a $750,000 capitalized farm to a $3.4 million capitalized farm? And help avoid the pitfall of just jumping in blindly and hoping that it will all work out, which ultimately creates some very significant financial stress in a very short time. So those are the issues that I wanted to talk to you about today regarding financial stress. I'll flip to the last slide of my slide set here, where I periodically throughout this discussion I have referenced that OSU Farm and Ranch stress test publication, which has the little stoplight diagrams that I referred to in it. That's publication number AgEcon, AGEC-237, that can be found from our series of publications. Very useful as we start to address some farm financial stress issues. Also, I would ask you to please complete a quick survey regarding this webinar before we log off. And that quick Qualtrics survey can be found at the URL that's listed on this last slide. I believe if you click on that, it'll take you directly to that survey. And finally, I'd like to encourage you to pose any questions that you have very quickly in the chat box, or email me directly. My email's listed there on the last slide. And with that, I'll turn it back over to Brent to see if he has any closing comments. But don't hesitate to post any questions in the chat box or send me an email.
Thank you, Dr. Jones. I would like to remind everyone that our next webinar is January 30th. And Dr. Shannon Farrow will discuss landowner rights when leasing a person's land for non-agricultural uses. So, if there are no questions, thank you for joining us today, and we'll see you on the 30th.